I want you to pause for a moment and really sit with the gravity of what is unfolding right now. Because this is not just another trade announcement, not just another economic partnership that will generate headlines and then fade into the background noise of global commerce. And certainly not just another example of countries diversifying their trading relationships in response to American policy uncertainty. What we are witnessing is Mexico and China formalizing an economic integration agreement so comprehensive, so strategically calculated, and so deliberately timed that it represents the single largest geopolitical realignment in the Western Hemisphere in half a century. And the decision was finalized 1 minute ago in a signing ceremony in Beijing that American officials only learned about when markets opened. I have spent decades watching power from the inside. First, as a Republican insider who helped construct the legal and institutional frameworks that governed conservative economic policy, then as a constitutional lawyer who has argued cases about federal commerce authority and international trade obligations. And I can tell you with absolute certainty, what Mexico and China announced 1 minute ago is not a defensive response to American tariffs or a negotiating tactic designed to extract concessions from Washington. It is a comprehensive strategic pivot that transforms Mexico from America's primary nearshoring partner into China's gateway to Western Hemisphere markets. And the implications will cascade through American manufacturing, reshape global supply chains, and fundamentally alter the balance of economic power in ways that will define the next generation. So I want you to ask yourself 3 questions. First, what happens when your largest trading partner, a country that conducts $780 billion in bilateral trade with the United States annually, signs an economic integration agreement with your primary strategic competitor that explicitly prioritizes Chinese market access over North American integration? Second, what happens when $67 billion in Chinese direct investment announced as part of this agreement begins flowing into Mexican manufacturing infrastructure specifically designed to serve Asian and Latin American markets rather than American consumers? And third, what happens when the New York Stock Exchange opens in 3 hours and American investors begin repricing the value of companies whose entire business models were built on the assumption that Mexican manufacturing would remain oriented toward American markets? These are not theoretical questions. These are being answered right now in real time in emergency calls between CEOs and board members in strategy sessions at the Treasury Department that's just learning the full scope of what Mexico and China have negotiated. Systems don't collapse overnight. They erode slowly through moments exactly like this. And the erosion we are watching began when the Trump administration made the catastrophic miscalculation that threatening Mexico with tariffs would force compliance, rather than triggering exactly what we're now seeing: a fundamental reorientation of Mexican economic strategy that hands China the hemispheric presence it has been seeking for 2 decades. For more than 3 decades, since the North American Free Trade Agreement took effect in 1994, the United States and Mexico built an economic integration so deep and so sophisticated that it became the foundation of American manufacturing competitiveness in the global economy. Not because of ideology about hemispheric cooperation or sentiment about cultural ties, but because it created extraordinary economic efficiency that benefited corporations and workers on both sides of the border. Manufacturing supply chains, particularly in automotive, electronics, and aerospace, became so intertwined that the concept of a Mexican product or American product became meaningless in practical terms. A Ford F-150 assembled in Dearborn, Michigan, contains components that cross the US-Mexico border an average of 8 times during production. An iPhone assembled in China contains precision components manufactured in Guadalajara that were designed in California. The system worked because it was predictable, because both governments understood that the infrastructure represented hundreds of billions in sunk capital investment that created mutual dependencies neither side would casually threaten. And mutual dependency, when it operates within stable political frameworks, creates the kind of boring reliability that allows multinational corporations to make 20-year capital allocation decisions with confidence. American companies knew they had access to competitive labor costs with minimal logistics complexity. Mexican manufacturers knew they had guaranteed access to the world's largest consumer market. The infrastructure on both sides, the border crossings and rail connections and just-in-time logistics systems and regulatory harmonization, all of it represented investment that made North America function as a single integrated production platform. That boring predictability enabled General Motors to build supply chains where a transmission crosses the border 6 times during manufacturing. It enabled Boeing to establish aerospace component production in Mexico with confidence that parts would arrive at assembly facilities in Washington state on precise schedules. It enabled American retailers to build business models around predictable access to Mexican manufacturing that kept consumer prices low while maintaining profit margins. When economists discussed nearshoring as the future of American manufacturing strategy, Mexico was always the centerpiece because of this infrastructure and integration. The relationship represented more than trade flows. It represented institutional trust built through generations of cooperation, dispute resolution mechanisms that actually worked, regulatory frameworks that aligned. But that assumption of predictability, that confidence in the boring stability of a relationship that had survived multiple administrations from both parties and had been codified in the USMCA just 4 years ago, has been systematically destroyed in the span of 3 weeks. And what Mexico and China announced 1 minute ago is the formalization of an alternative that makes American market access optional rather than essential. What triggered this moment wasn't a legitimate policy disagreement about trade balances or regulatory standards that could be resolved through the established dispute mechanisms that exist precisely for this purpose. It was a public ultimatum delivered via social media, designed for maximum domestic political theater in the United States and maximum humiliation for Mexico's government. Not a request for enhanced cooperation on border security issues where genuine policy coordination was possible. Not a proposal for modernizing USMCA provisions or addressing specific trade imbalances through technical negotiations. A demand that Mexico deploy military forces to effectively function as an extension of American immigration enforcement along Mexico's northern border, backed by the explicit threat of 25% tariffs on all Mexican exports to the United States if compliance wasn't achieved within 72 hours. The ultimatum wasn't framed as opening negotiations between sovereign partners. It was framed as an order from superior to subordinate that assumed Mexican policy was subordinate to American domestic political priorities. And it came with a deadline calculated to make compliance appear as capitulation, 72 hours. As if the deployment of military resources and the fundamental reorientation of a nation's security posture were decisions that could be made over a weekend without legislative input or consideration of Mexican sovereignty and domestic political realities. For President Claudia Sheinbaum, who had campaigned explicitly on a platform of asserting Mexican independence, and who governs in a political environment where kowtowing to American demands would be politically fatal, the calculation was straightforward but devastating in both directions. Agreeing to the demand would establish the precedent that Mexican sovereignty on matters of territorial security is negotiable based on American political cycles and whatever demands might emerge next from Washington. It would make Mexico a client state whose policies adjust to American ultimatums rather than Mexican interests. Refusing the demand would trigger tariffs that economists immediately projected would reduce Mexican GDP by 3.4% in the first year, devastating automotive and manufacturing sectors that employ 2.5 million people directly and support millions more indirectly through supply chains. Both options carried catastrophic costs, but one preserved the fundamental principle that Mexico makes independent decisions about its own territory and its own strategic priorities. The other sacrificed sovereignty for temporary economic relief that could be revoked whenever Trump decided it served his domestic political purposes. And that is the line Mexico refused to cross. But rather than simply refusing and preparing to absorb tariff damage, Mexico made a decision that represents the most significant geopolitical realignment in the Western Hemisphere since the Cuban Revolution. Within 48 hours of Trump's tariff announcement, Mexican trade officials were on planes to Beijing, carrying proposals that had clearly been prepared in advance, refined through months of quiet diplomatic preparation. And 1 minute ago, in a signing ceremony at the Great Hall of the People in Beijing, those proposals became binding agreements that will reshape hemispheric trade for generations. Within minutes of the announcement, the effects began cascading through global financial systems in ways that revealed just how unprepared markets and policymakers were for the scope and speed of what Mexico and China had negotiated. The agreement, formally titled the Mexico-China Strategic Economic Partnership and Infrastructure Integration Framework, contained provisions that went far beyond a typical trade deal. This wasn't tariff reduction or market access negotiation. This was comprehensive economic integration explicitly designed to create an alternative to North American supply chain dependence. The core investment commitment was staggering in scale and strategic in focus. China committed $67 billion in direct investment over 5 years, with $34 billion allocated in the first 18 months. Not investment in Mexican industries oriented toward American markets. Investment specifically in Pacific port infrastructure, rail connections from those ports to Mexican manufacturing centers, and industrial parks designed for Chinese companies producing for Asian and Latin American markets rather than North American consumers. The agreement included $12 billion for port expansion at Manzanillo and Lázaro Cárdenas, transforming them into logistics hubs capable of handling container volumes that rival Los Angeles and Long Beach. Another $8 billion designated for rail infrastructure connecting those ports to manufacturing centers in central Mexico, creating logistics corridors that bypass the U.S. border entirely. The remaining $47 billion allocated to industrial park development, technology transfer agreements, and direct investment in Mexican manufacturing, specifically targeting sectors where Mexico had been integrated into American supply chains: automotive components, electronics assembly, aerospace parts, and medical devices. When a factory stops, there's no narrative that fixes it. But when $67 billion in foreign direct investment creates entirely new production infrastructure oriented away from American markets, you're watching economic geography being redrawn in real time. The automotive sector provisions were particularly devastating for American interests because they targeted the crown jewel of North American integration. The agreement established investment commitments from Chinese automotive companies, including BYD, Geely, and SAIC Motor, to build production facilities in Mexico with combined capacity of 1.2 million vehicles annually. Not vehicles for the American market, vehicles explicitly for Latin American, Asian, and European markets. The agreement included provisions for technology transfer and electric vehicle production, battery manufacturing, and autonomous driving systems, areas where Chinese companies have technological advantages and where Mexican production had previously been oriented toward American partnerships. Ford and General Motors had invested billions in Mexican production, assuming that manufacturing would serve North American demand. The China-Mexico agreement creates direct competition using Mexican labor and Mexican logistics, but oriented toward Chinese technology and non-American markets. The electronics and technology provisions revealed the strategic sophistication of what had been negotiated. China committed to relocating significant portions of its electronics supply chain to Mexico, not to avoid American tariffs on Chinese goods, but to create a Western Hemisphere manufacturing base that serves global markets while reducing dependency on both American consumers and Chinese territorial vulnerability. Companies like Foxconn and Luxshare, which currently manufacture in China for global brands, committed to establishing Mexican facilities with explicit provisions that production could serve any global market. The strategic implication was unmistakable. Mexico was positioning itself as a neutral manufacturing platform that could serve American, Asian, European, and Latin American markets based on commercial logic rather than political alignment. But the financial integration provisions were what sent immediate shockwaves through currency and bond markets. The agreement established yuan-peso currency swap lines worth $15 billion, allowing Mexican companies to conduct trade with China without dollar intermediation. It created provisions for Chinese banks to establish significant presence in Mexico, offering financing for Mexican companies that wanted to diversify away from American banking relationships. It included commitments for Chinese purchases of Mexican sovereign debt, providing Mexico with alternative financing sources that reduce dependence on American investors and international institutions where the United States holds effective veto power. As the news circulated, something extraordinary started happening in financial markets around the world. Not panic selling or dramatic volatility, but immediate, substantial repricing of assets and strategic positions based on recognition that fundamental assumptions about hemispheric trade had just been invalidated. In Hong Kong, where markets opened first, the Hang Seng Index jumped 3.4% in the first hour of trading, with Chinese manufacturing and logistics companies posting even larger gains. BYD, the Chinese electric vehicle manufacturer that signed commitments for Mexican production, gained 8.7%. COSCO Shipping, which would operate expanded Mexican port facilities, jumped 6.2%. Chinese investors were pricing in exactly what the agreement meant: access to Western Hemisphere manufacturing and logistics that had previously been dominated by American companies. In European markets, the response was more complex but equally significant. German automotive companies, particularly Volkswagen and BMW, which had invested heavily in Mexican production for the American market, saw immediate pressure. Volkswagen dropped 4.3% as investors calculated that Chinese competition in Mexican manufacturing would erode advantages that German companies had built through decades of investment. But European logistics and infrastructure companies gained on the assessment that the Mexico-China integration would create opportunities for European firms to participate in Pacific trade routes that bypassed American dominance. In currency markets, the peso strengthened 2.8% against the dollar in overnight trading, a massive single-session move that reflected investor assessment that Chinese investment would provide peso stability and that Mexico had successfully diversified its economic dependencies away from exclusive American orientation. The yuan strengthened modestly against the dollar as markets priced in that China had secured strategic economic presence in the Western Hemisphere that would reduce vulnerability to American pressure in Asia. But the real damage was waiting for when American markets opened. Futures trading indicated the S&P 500 would open down approximately 380 points, with particularly severe pressure on American manufacturing, automotive, and retail sectors. Ford's after-hours trading showed the stock down 7.2%. General Motors was down 6.8%. Tesla, which had significant Mexican manufacturing operations, dropped 5.4%. American investors were pricing in the recognition that competitive advantages built on Mexican integration were being systematically undermined by Chinese investment that would create direct competition. Within 3 hours of the announcement, emergency analyst calls were being convened by major investment banks to assess implications. Morgan Stanley's global strategy team issued a rapid assessment, noting that the Mexico-China agreement represented, quote, the most significant shift in hemispheric economic alignment since NAFTA, and that American companies with significant Mexican operations faced, quote, fundamental strategic reassessment of business models built on assumptions of Mexican-American integration. Goldman Sachs was more direct, noting that if Chinese investment proceeded as outlined, Mexican manufacturing would increasingly orient towards serving Asian and Latin American markets, and that, quote, American market access, historically Mexico's primary strategic advantage, would become one option among many rather than the organizing principle of Mexican economic policy. JP Morgan's geopolitical risk team focused on what the agreement signaled about American influence. The analysis noted that Mexico's willingness to formalize deep economic integration with China, despite knowing it would antagonize Washington, demonstrated that the calculus of middle powers has shifted fundamentally, and that American leverage through market access is declining in value relative to the costs of subordination to unpredictable American policy. These weren't political assessments by analysts with ideological axes to grind. These were financial institutions with trillions in managed assets, making cold calculations about how value was being created and destroyed by geopolitical realignment. This is where the administration's fundamental misunderstanding of leverage in an interconnected global economy becomes impossible to ignore. The assumption seemed to be that threatening Mexico economically would force compliance, because Mexico needs American markets more than America needs Mexican manufacturing. That assumption ignored three critical realities that have emerged in the past decade. First, China has become a viable alternative market and investment source for middle powers in ways that weren't possible 20 years ago. Chinese consumer markets, Chinese investment capital, and Chinese technology transfer create options for countries like Mexico that reduce dependence on American economic relationships. Second, the global economy has shifted such that manufacturing platforms like Mexico can serve multiple regional markets simultaneously. Mexican production doesn't need to choose between American and Asian markets. It can serve both, and increasingly can serve Latin American and European markets as well. Third, and most critical, American threats have taught middle powers that deep integration with the United States creates vulnerabilities that can be exploited when American policy becomes unpredictable. Better to diversify and accept short-term costs than to remain dependent on a partner who weaponizes economic relationships for domestic political purposes. And here's what those market movements and analyst assessments were pricing in. Once Mexico begins this reorientation with Chinese support, the incentives shift fundamentally and permanently, and American policy changes cannot reverse what has been set in motion. What makes this moment particularly dangerous is understanding how power actually works in the modern global system, and why the assumptions driving this administration's approach are catastrophically misaligned with how middle powers respond to threats in an era where alternative partnerships are available. For decades, American dominance in the Western Hemisphere rested on two pillars: overwhelming economic presence through market access and investment, and perceived reliability that made partnership with the United States stable and beneficial over long time horizons. The first gave Washington leverage in negotiations with Latin American countries. The second gave those countries confidence that cooperation with the United States represented the optimal long-term strategy, even when specific negotiations were difficult. When those two pillars reinforced each other, the system worked extraordinarily well for American interests. American market access made economic integration rational. Reliable American policy made deep supply chain integration seem strategically sound. What Trump is doing now systematically undermines the second pillar, while providing China with the opportunity to offer a compelling alternative to the first, and doing so in a way that creates exactly the outcome American strategic planners have feared for 2 decades: significant Chinese economic presence in the Western Hemisphere. You can't coerce cooperation when coercion demonstrates unreliability. You can't threaten a partner into dependence when alternatives exist. Once you understand this framework, everything Mexico is doing makes perfect strategic sense, and everything China is doing represents sophisticated exploitation of opportunities that American policy has created. The confusion isn't in Mexico City or Beijing. The confusion is in Washington, where policymakers seem genuinely shocked that threatening America's closest trading partner creates opportunities for America's primary strategic competitor. Mexico's decision to formalize comprehensive economic integration with China wasn't emotional or reactive, despite how it will inevitably be characterized by administration officials searching for narratives that deflect responsibility. It was a calculated strategic decision by a government that understands the difference between short-term economic disruption and long-term strategic disaster. Scheinbaum looked at two futures. In one, Mexico remains exclusively oriented toward American markets and accepts that Mexican policy is subordinate to whatever demands emerge from Washington based on American domestic political calculations. In that future, the next ultimatum is always coming, and Mexican sovereignty is always negotiable. In the other future, Mexico accepts short-term costs of American tariffs and uses Chinese investment to build infrastructure and supply chains that make American market access important but not existential. In that future, Mexico has options, and options are sovereignty. She chose the second future. And here's the part that should terrify American strategic planners. China's decision to offer comprehensive partnership at exactly this moment represents strategic opportunism of the highest order. For 2 decades, American policymakers across multiple administrations have worked to prevent exactly what just happened: significant Chinese economic integration in the Western Hemisphere that would give Beijing strategic presence near American borders. The policy, regardless of whether Democrats or Republicans held power, was consistent. Use American market access and financial leverage to make partnership with China less attractive than partnership with the United States. Trump's tariff threats broke that logic. By demonstrating that American partnership comes with subordination and unpredictability, the administration made Chinese partnership relatively more attractive. The people paying the price are not the architects of this policy. They're American workers in automotive plants in Michigan and Ohio who will face job losses as production advantages erode. They're American families who will pay higher prices for vehicles and consumer goods as supply chains fragment. They're American investors who will watch value destroyed in portfolios as companies built on Mexican integration face Chinese competition. They're American strategic interests that will cope with Chinese economic presence in the Western Hemisphere that decades of policy tried to prevent. The world has already moved on. The agreements are signed in Beijing. The capital is committed. The infrastructure construction has begun. The supply chains are reorienting. The question now is whether Washington understands what has been lost, and whether the recognition will come before or after the damage becomes irreversible. Markets will answer that question when they open in 2 hours, and the answer won't be kind.